Hello guys, welcome to Bhamna's Online Academy. So today we are going to learn AS 29, which speaks of provisions, contingent liabilities and contingent assets. So before I start with the video, let me tell you that this is the part 1 of the video which will cover all the concepts. There's going to be a part 2 to this video which will cover all your ICI questions, which includes your illustrations and test your knowledge. So do make sure to watch both the parts to get complete coverage. And then the notes that I'll be using today, these handwritten notes will be available on my Telegram channel, the link of which is in the description box below. So make sure to check out that too. So without any further ado, now let's begin with the video, guys. So starting with the first one, which is provision. So what is a provision? Okay, so in this AS, you're going to learn three things. What is provision, what is contingent liabilities, and what is contingent assets. If you understand provisions properly, the other two are going to be very easy for you. So we are going to spend a lot of time understanding provisions, and then we will go on with our contingent liabilities and contingent assets. Okay. Now starting with provision. What is a provision? Provision is nothing but a liability. Okay. So here what does a liability mean? We'll understand. But please understand that liability with a mixture of estimation. That liability plus estimation. If there is a liability and you don't know what is the exact amount that this liability will be of, and if you have just made an estimate to it, then it will be called as a provision. What is a provision? Provision is nothing but liability mixed with your substantial degree of estimation is your provision. Now we are going to understand what does liability means. Liability means it is a present obligation arising as a result of past events. That means you did something in the past. You have already done. The act is already done in the past. You have done an act in the past due to which today you have some obligation. Okay. Yes. So now what does present obligation means? Present obligation means such obligation should exist on the balance sheet date. So here let me tell you, in a crisp manner that what happens is in the past you have done some act. Suppose what has happened, there was a red signal. Okay. There was a red signal. Now just imagine it's a red signal, and they had said in the law that if you cross this red signal, when the signal is red, if you cross it, you will be charged a fine. Now what you did was you crossed the signal when it was red. So now there was the event that you had done. Okay, you had crossed the red signal. That means it was a past event. Okay, and now because you have crossed it, now you will have to pay a fine. So you have not yet paid, but you will have to pay a fine. So there is a present obligation on you. Okay, and now how does this present obligation has arisen? It is because you have acted in a specified manner. Okay, you have acted in a specified manner, and because legally you were bound to pay a fine, you are going to pay a fine. Either the obligation can be due to constructive obligation, also legal obligation. Also, constructive obligation means there is a particular history or past trends due to which this obligation arises. It is not written in the law. Okay, so other than law, if you're doing something, that counts as your constructive obligation. Okay, so now if I, for example, let me give you an example, okay, of constructive obligation. So here what happens is that, you are a mining company, for example, and what you do is every time you do the mining activity, you restore the land by yourself. Okay, nobody has come and told you that, but every time after you do your mining activity, you come and restore the land. So that's what you have been doing in the past also. So now what happens? Due to this, they will think that this time also when you're going to mine, you are going to restore the land. So it is a constructive obligation on you. Either due to a constructive act, obligation may arise, or due to a legal act, your obligation may arise. So legal act example, I told you, you are breaking a signal, or constructive act may be the mining. Now if you don't restore the mine, the people who are living in and around can complain, and obligation may arise on you. So like that. So like I told you, what is a provision? Provision is a liability with a little bit of mix of estimation. So you don't know what your exact amount of liability is going to be, but there is an estimation involved in that. Okay. And here what is liability? Liability is a present obligation arising out of a past event. That means in the past you had done some mistake. Okay. So because of that, what happens is today you will have to pay out something. Okay, you have an obligation, present obligation. That means as on the balance sheet date, you have an obligation. Okay, and The obligation might be in two different forms. Either it might be a legal obligation where you might have to pay fines, penalties, etc., or a constructive obligation like because of your past acts, today also you have to do it, or it might be a responsibility or a duty that you have to act in a specified manner. So, any kind of obligation it can be. I hope you understood what does provision mean. Okay, now when do you recognize a provision? When do you recognize a provision? Okay, so basically provision is recognized in your balance sheet. So this is a liability, like I told you, so it comes in the balance sheet. But the only difference between liability and this is liability, you have a fixed amount that your creditors, you have to pay 1 lakh rupees for all the raw materials you have purchased. Now in provision, that amount will not be certain. Now you have not restored the mine, you have not restored the land, okay, of the mine. Now how much fine they will put on you or what will happen, that you're not very sure, like you're able to estimate that suppose 1 crore of fine can come upon us, etc., but you don't know exactly. So there is the estimation involved. Now recognition of provision, so here what happens is you have to fulfill three conditions for you to recognize this provision in the balance sheet. For you to recognize this provision in the balance sheet, you have to fulfill three conditions. Even if any one of the condition is not fulfilled, it will not be called a provision. Okay, so if you fulfill all three conditions, it will become a provision. Even if one condition you don't fulfill, it will become your contingent liability. It will become your contingent liability. So now what, first let's understand what are the three conditions. First, they tell you that an entity has a present obligation arising out of past events. I told you, you must have already done an act. It should not be like if you do, it will happen. You must have already done it. Okay, it should be of a past event because of which today you are under an obligation. Okay, then they tell you that it is probable that more than 50% chance is there that there will be an outflow of resources. So here they are saying that now what has happened, suppose you broke the traffic signal. Now you know that the person or the policeman who is standing there, he will not put any fine on you. Here you have done a past act, there is an obligation on you to pay the fine, but you know that the policeman or the traffic police is your friend, so now he is not going to, or maybe you are the son of a big police officer, so now even if you have broken the signal, you need not pay any money. So here it is not probable that you any outflow will happen, so it must be more than 50% a chance should be there that a outflow of resources will happen, or in simple terms, an outflow of money will happen. Okay, so more than 50% chance would be there. If you're a normal person, will you have to pay the fine? The answer is a big yes. So here there will be more than 50% chance that an outflow will happen. Okay, then a reliable estimate should be made. So you must be able to estimate that how much amount is going to go out of your pocket. Okay, which is going to be 1,000 rupees or 1 lakh rupees. If you have no clue, then how are you going to record it in your balance? You'll not be able to record it, right? So you need to be able to make a reliable estimate out of it. Okay, so now let's understand again, when will you recognize? When three conditions are met. One, a past event must have happened because of which today you have an obligation, and it must be probable. That means more than 50% chance should be there of the outflow going from your pocket. That means you will be paying out money, and that you must be able to estimate also. So if all these three conditions are present, it will become your provision. Okay, now we are going to read certain question related points about provision. Okay, so how are you going to calculate the amount of provision? Okay, so here there may be two possibilities. Either there will be only one possible outcome, so there may be many possible outcomes. Okay, so if you have done a particular, if you have broken a red signal, okay, either it might be that you know that only 1,000 rupees fine they will put on me, so it is only one possible outcome, then you can consider that amount directly. So 1,000 rupees, you can record it in your books directly, you can record it in your books directly. But if there are many possible outcomes that you don't know, okay, then you think that suppose there is a legal case on you. Okay, and you think maybe you will lose the case, and then there are a lot of possibility that how much amount you will have to pay. So if there are many possible outcomes and you don't know exactly or the nearest estimate or what the management thinks, even management is doubtful that which one we will have to pay, they don't know. So in that case, you use something known as expected value method using probability. So now they will tell you 60 lakh rupees you will have to pay, there is a probability of 6%. 40 lakh rupees you have to pay, there is a probability of 40%. Okay, 60%, 40%. So like that you have to multiply the amount with the probability and find out how much will be your provision. Okay, there is a question on this. When we do the questions, I'll explain it better. But basically you have to take the value and multiply it by the probability and find out what the provision will be. Okay, Yeah, so this was the first question. Point second, they tell you then this is a very simple point. So what for whatever purpose you have made the provision for the same purpose only you have to use it. So provision can be used only for the purpose it is made. You cannot make a provision for warranty and then use it for a provision to pay some other penalty. That you cannot do. For what purpose a provision is made, for the same purpose only it should be used. Next is provisions which are adjustments to carrying amount of assets are not covered by the CA. So now in your balance sheet, in your PNL, you would have also seen PNL balance sheet, you would have heard of provision for doubtful debts. That means if a debtor is there, okay, and you're doubtful that this debtor is not going to pay you, then in such case you make a provision, right? That doubtful debts, we don't know if it's going to pay or not. Provision for depreciation, provision for impairment. So all these are asset related provisions. So asset related provisions are not covered under this AS. Only the liabilities related provisions are covered here. Example, a provision for penalty, provision for warranty, where you have to pay, where there is an outflow, where there is a outflow. Here what happens when you do doubtful debts, when you make a provision for doubtful debts, you are not going to receive any money. Neither there is inflow nor there is outflow. You are not going to receive basically. But when you are saying provision for liabilities, that means there is going to be an outflow. So only liabilities this AS is going to cover. Provision related to liabilities this AS is going to cover. Okay. Next is obligation. So that was your point. Okay, only liabilities related provision it covers. Next point, they said obligation over to third party. So here, if there is a payment that you have to make to the third party, okay, and it may be over to public at large, maybe a big area you have damaged because of which a lot of public you have to concentrate. Compensate. Here, it is not necessary that for you to know that which party it is or what identity of the parties. Even if you're obliged to pay to the third party and you know it is paid to the public at large, still if there is any obligation like that, you have to record it in your books. It is not necessary that you find out who the exact person is to whom you have to pay. The identity is not necessary. Okay, if it is owed to third party, you can still record it in your books. Okay. Next is new law requires. So in case if there is a new law that's coming in, okay, so from next year onwards, they are saying that people whoever are going to throw any waste on the road, okay, like your chips packet and your chocolate wrappers, all that if you're going to throw on the road, you are going to be fined. So like that a new law is going to come. So if it requires rectification of damage caused by the entity, let me take another example. Okay, so this is one example. Another example might be next year. So whichever company has thrown waste in the river, they are going to be fined. In the river, they are going to be fined. So here what happens is that if like something like this, a new law like this comes, and such event will be considered as an obligating event in the year in which such damage needs to be rectified. So now what the law tells you is that, so company whoever has thrown the waste in the river will be fined, or what you can basically do is you can rectify the act, or basically you can rectify the act. Okay, so here where what they are saying is, till now the law has not come. In the year in which this law comes, in the year in which the law is going to come, in that year we will find, in that year only you have to record the provision. You need not record it in this year itself. So when the law comes, that year you record the provision. Before itself, no need to record it. Okay, that's what they are trying to tell you. Okay, next they are saying provision need not be discounted to its present value. So provision is made for a future date. Today you're not going to make this expenditure, so because it's on a future date, don't take it as a future value and then discount and bring it to the present value. No need. Whatever the actual provision amount is, just write that. If you think if after 2 years 10 lakhs you will have to pay, no need to bring it to the present value. Just record it in your books as 10 lakh provision. Okay, so yes guys, so this was all about your provisions. Yes, now we are going to understand a few special points in which we are going to understand about three topics. One is your reimbursement, onerous contract, and restructuring. So starting with your reimbursement. So here what they tell you is that basically, now there is a customer, this is me, and then there is a supplier, this is the supplier who has basically supplied me some soaps. Okay, and the same soaps I have sold it to the customer. Now what happens is that I have sold, suppose 10,000 rupees worth of I purchased around 8,000 worth of soap, and 10,000 worth of I have added my profit, etc. Now of 10,000 rupees I have charged to the customer. Now the customer, what happened, he used the soap, he or she used the soap and they got allergy. Now what happens is the customer is coming and telling, this is very wrong. Now you will have to refund me the whole amount. Because of you I got a soap allergy, etc. So here what happens is that now here as a company we are going to, because a bad product or a faulty product we have supplied to the customer, we are now ready to reimburse to the customer. So now to the customer we are going to reimburse suppose 10,000 rupees. Now what happens is, now the who has supplied the soap, the supplier has supplied the soap. Will you leave him just like that? Okay, it's okay, yes, supplied me some faulty product, it's okay, it's fine, I'm going to forgive him. The answer is no. If you're a true businessman, you're going to go back to the supplier and tell him, hey listen, there was a customer who came who said he got a soap allergy and he got 10,000 worth of money from me. The same way now you will have to refund me, you have to refund me for the faulty soaps you have provided or the bad conditioned soap that you have provided. So now the supplier can also agree to pay you 8,000 rupees. So here what happens, from your hand 10,000 rupees is going, but in turn you're receiving 8,000 for it. So there is an expenditure that is expected, that is going to happen because you have to give it to the customer, and the same expenditure is going to be reimbursed. So that 8,000, so here what happens basically, wait, so here, so here 10,000 rupees you will pay to the customer, but 8,000 rupees you are getting from the supplier, correct? So you are making expenditure of 10,000, but 8,000 is being reimbursed. So expenditure is expected to be reimbursed from the third party on settling an obligation, and if it is virtually certain that there is more than 95% chance that the supplier will give you that 8,000 rupees, then in such case what you have to do is that reimbursement will be received. Okay, so here you have to do two treatments. One is in the balance sheet and the other one is in the profit and loss statement. So here what you have to do is, in your P&L account, you have to record as a provision expense and reimbursement as an income. So basically whenever you're preparing your P&L account, right? So you're going to show provision. Suppose you have to pay provision, you have made a provision for expenditure and that's coming up to 10,000 rupees. In that what you can do is you can show the reimbursement you are going to pay. So you can net it off and show, basically you can show as minus reimbursement of 8,000 you're going to receive. So net of 2k you have to pay. But you have to show it separately. Directly, please don't write it as 2,000. Directly don't write it as 2,000 rupees. Show it as two different items. Provision 10,000 minus reimbursement of 8,000, and 2,000 will be your net of expense. So you can basically net it off and show. No need to show as income separately and expense separately. You can net it off and show. But when it comes to balance sheet, you have to remember that you have to treat that reimbursement as a separate asset only. So reimbursement you will account separately, provision you will account separately. So provision you will account it under the liability section, reimbursement you will account it under the asset section. Please do not net off in your balance sheet. Okay, I hope you understood this. Here, always remember that your reimbursement should not exceed your provision amount. So you are basically paying to the customer 10,000. You're paying to the customer 10,000 rupees, and reimbursement you have written that 12,000 you'll get reimbursement. So 2,000 is your profit or income. Like that you cannot show. This is very wrong. Like this, people will then start manipulating their accounts. They'll show more reimbursement and all. No. So your reimbursement can only be till the maximum amount of provision. So maximum reimbursement that you can record in your books is only up to 10,000. More than that you cannot record. Okay. Next is, if reimbursement is not virtually certain, that means you're not sure, 95% chance is not there that you'll get the reimbursement, then just disclose it in the financial statements. Okay, if you're less than 95% sure, then just disclose it in the notes to financial statements. Okay, so this was all about your reimbursement. Next, we are going to understand about onerous contract. So here they tell you that onerous contract is, in simple terms, if I tell you, it is nothing but a loss making contract, that irrespective of whatever you do, you are going to make a loss only in this. Okay, so the contract in which unavoidable cost of meeting the obligation exceeds the economic benefits received. The amount of benefits you're going to receive in it is very less than how much cost you're going to spend on it. So the cost you're going to spend on it is going to be way more than the benefits you're going to receive in this contract. So in such contracts, how do you make a provision? So in such contracts, you have to make provision which is lower of cost of fulfilling the contracts. If you're going to go and fulfill the contract, how much cost are you going to incur? Or the penalty for non-performance of the contract. So you'll tell, no, if there is a loss making contract, then why are you doing that contract? Cancel the contract. But in real world, it does not happen so easily. There'll be a penalty that you have to pay to cancel a contract. So see, whether a penalty is more or cost of fulfilling the contract is more. If the, suppose, so as a normal person, what you would do, if the penalty is less, the cost of fulfilling the contract is 1 lakh, the penalty you have to pay for not doing that contract is only 10 20,000, then you will just pay 20,000 and chuck off that contract or leave the contract. Correct. So in such case, see what will be the lower of what will a normal person do? Will he pay the penalty or will he pay the cost? So he is going to pay the penalty 20,000. So record that as a provision. So record that as a provision. That means that is a minimum cost that you have to pay. So cost of fulfilling the contract to making that product, how much cost we say cost you're going to spend, or the penalty for non-performance of contract, whichever is lower. Here always remember, do not set off the expected profit on contract against the provision. Now suppose you are doing a contract, okay, and in that contract you are going to earn, suppose you the cost you're going to spend is 1 lakh rupees, in that you're going to earn 10,000 rupees of profit. Here what they are saying is the provision that you're going to create, suppose the penalty is 20,000 rupees and you have decided that you're going to create a provision of 20,000. So 20,000 provision if you're creating, please do not do minus 10,000. So net of 10,000 only is the provision, like that you should not do. Here you should not net off the expected profit on the contract. Okay, because here there are chances either you may fulfill the contract or not fulfill the contract also. So please do not set off that expected profit because it's not earned yet. So unexpected uncertain gains you should not record in your books, correct? So please don't do that. Please do not set off your expected profit with the provision that you're going to create. Okay, done. Next, so this was all about your own risk contract. Next, you're going to see about restructuring. Restructuring means basically you make a change in your business, either in your scope of business or the manner in which you conduct the business. If you are going to make a change or you plan to change, then it will be known as your restructuring. You give a new face to the already existing business. They say the amount of provision what you're going to keep for restructuring. So whatever direct expenditure you're going to incur, no, related to this restructuring, you have to create a provision for that. Now, when you're doing a restructuring, suppose you have to spend some cleaning cost, you have to give some staff money. So like that, if anything which is related to restructuring, if that is directly related to such restructuring, suppose your transportation cost for carrying your goods, etc., so all that will come under your provision amount. Okay, but you always remember that it should not be associated with the normal course of business. That means there is a staff. Okay, irrespective of whether you do the restructuring or not, this staff will be paid the normal amount. Now if you're doing restructuring and paying the staff extra, that is different, but the normal pay that the staff gets, irrespective of whether the restructuring happens or not, that normal cost you should not consider. Only the extra cost that you might have to bear because of the restructuring, that alone take it as a consideration for making provision. Otherwise please don't consider other things. Normal cost don't consider, which is regularly are paying in the business, which is not, which is associated with the normal course of business, don't take in that. Okay, in second point they tell you that no need to recognize a provision for sale of an operation until the enterprise and entered into a binding sale agreement. It's all about your restructuring. I hope you understood clearly. So now until now we have understood what is provision, recognition of provision when you will do, what are the special points under that. We read three: reimbursement, onerous contract, and restructuring. Okay, so now let's start with contingent liability. So what does contingent liability means? First let's read here in simple words. If a provision is not able to meet the satisfaction criteria, we said no, it has to meet here, right? We read that three conditions should be satisfied. If even if any one of the condition it is not able to satisfy, then in such case you can book it as a contingent liability. Then you can book it as a contingent liability. That's what I've written here in simple words. If a provision could not be made due to the non-satisfaction of any of the above conditions or the three conditions that we read, then show it as a contingent liability. In simple words, that is what is a contingent liability. So here they have expressed it in two forms. First, let's read this one. It is a present obligation which is arising out of past events. One condition is fulfilled here. What were the other two conditions? That outflow of resources should be there, that it must be probable, that means more than 50% chance should be there, and the amount should be estimated reliability. For all these three conditions are met, it will become a liability. Now suppose one condition is being met, it is a present obligation arising of past events, but outflow of resources is not probable, that only less than 50% of chance is there, or outflow of resources is possible but amount can't be estimated reliably. So any of the two conditions, either outflow of resources, this conditions is not getting fulfilled, or amount you're not able to estimate reliably, if any of these two conditions are not getting fulfilled, that means outflow of resources also less than 50% chances are only there, then in such case either, okay, any one also if you don't fulfill, then in such case it will become a contingent liability. So that is one case. Second case is where there is a possible obligation, that means a present obligation, this first condition itself is not meeting here. Here they are saying there is a possible obligation arising from past events. Okay, so here in simple terms, if I have to make you understand the difference between present obligation, possible obligation, so here you tell no that probable means you have more than 50% of chances. Here possible means the chances are more than 10% but less than or equal to 50%. So there are going to be three terms which is used here. Make note of it: probable, possible, and remote, or basically not possible or remote you tell. So if it's probable, that means more than 50% chance. Possible means more than 10% but less than or equal to 50% chance. Remote means less than or equal to 10% chance. Okay, so now it is a possible obligation. That means the obligation is going to arise. The chance of it is only from 10 to 50%, more than 10 to 50% only, arising from past events that that will be confirmed on occurrence or non-occurrence of one or more future events. That means you have made a mistake in the past, but this obligation will only get confirmed due to a event that is going to happen in the future, the occurrence or non-occurrence of a event. So in such case also it is going to be a contingent liability. If you're not able to remember any both of this, just remember this simple condition and you will be able to arrive at your answer. Next is, how are you going to recognize your contingent liability? Your provision you will show as a liability in your balance sheet. How are you going to show your contingent liability? Contingent liability will not be recognized. Will not be recognized means it will not be shown in your balance sheet or anything. It is just going to be disclosed in the notes to FS. So in the notes, you're going to just make a disclosure about its contingent liability. Like in the footnotes, you will disclose it. Okay. However, if the possibility of the outflow is remote, that means less than 5% chance. Okay. So less than 10% or less than 5%, very minimal chance is there. Okay. Then in such case, even disclosure is not required. Even disclosure is not. Normally, please disclose the contingent liability. But even if the chances of outflow are not even possible, it's not even possible outflow, that means minimum 10% also is not there. If it's less than that, remote, that is 10%, 5% like that, then in such case disclosure is also not required. Just leave it as it is. Okay. So here they are telling you one point that you have to remember: in case of a joint liability, part of the liability which is to be met by the other party is treated as contingent liability. Suppose there is a mistake you have done. You and your friend were going on bike and both broke the red signal. Now you will also have to pay, he will also have to pay. So for what you pay, you create a provision. For what your friend has to pay, in your books, please show it as a contingent liability. For what your friend has to pay, show it as a contingent liability. That's what they are saying here. In case of joint liability, part of the liability which is to be met by the other party will be treated as a contingent liability. Okay. I hope you understood. Next is review of contingent liability. So review, when do you review your contingent liability? So every balance sheet date you have to review your contingent liability, whether it has become a present obligation or not, or whether any all the three conditions it is fulfilling or not. If on every balance sheet date you have to assess it and check whether it is becoming a provision or a liability or not. Okay. Next is, if outflow of resources becomes probable, provision should be recognized for such contingent liability that I told. If it becomes probable, then in such case recognize it as a provision. Okay, and if everything goes perfectly, you can record it as a liability also. So that was all about your contingent liability. Now we are moving on to the final topic which speaks of contingent asset. So contingent asset is very easy. There is no treatment you have to do in the books for contingent asset. Just understand the meaning. So contingent asset is a possible asset which arises from the past events and that will be confirmed on the occurrence or non-occurrence or one or more future events. In simple terms, it is uncertain gains. Right? You don't know whether it will happen or not, but more than 10% to 50% chance is that this gain you will get. But gain you never record it in your books until you confirm. So it is neither recognized nor need any disclosure. Both you need not do. Provision, we said you have to recognize in your books as liability. Contingent liability, we said you will have to disclose. Contingent asset, you need not recognize, you need not disclose. No treatment for it. Just review at each balance sheet date whether it has becoming a asset or not. That's it. So yes guys, I hope you understood the standard. I've explained everything about AS29. And if there is any doubt, please leave that in the comment section below. Thank you so much for watching the video until now. See you in the next video guys. If you made until this, please make sure to like, share and also subscribe to the channel. Thank you so much for watching.